Good morning, everyone. My name is Paul Foreman, International Sales and Technical Manager at Nvidia Global, and welcome to the latest in our Advisor webinar series. This month, we're reverting to an investment theme, and I'm delighted to say that we've been joined by Stephen Yiu from Blue Whale. Stephen set up Blue Whale back in 2017 and is lead manager of the Blue Whale growth portfolio. And this morning, he's going to be running through how the portfolio has evolved over the last 5 years, and then going forwards, how it will weather current pressures such as inflation and interest rates, plus geopolitical tensions such as the conflict in Ukraine. Before I hand over to Stephen in a second, if you do have any questions during the presentation, there will be time at the end for us to run through those. And if you could field those via the Q&A button at the bottom of your screen, I'll collate those and we'll run through them with Stephen afterwards. So without further ado, I'll hand you over to Stephen now for today's session. Thank you.
Thank you very much, everyone, for joining us this morning. I have prepared a few slides to talk about how we have been through the last 5 years, and at the same time, what's our outlook for the next 5 years. And I also have prepared a few stocks and few themes that we can run through, and feel free to pencil in any questions after the presentation. So the first one that I would kick off is maybe just to remind our audience about the investment philosophy of the fund, the Blue Whale Growth Strategy. We aim to invest into high quality businesses at an attractive valuation. And the way that we go about this is we do all the research in-house, and then we translate our research into a unique financial model for every single company. And then we make medium-term forecasts in terms of how much money our company would make. And then that's how we gauge the valuation of our company, whether it's attractive or not. So we have been we have been using the same philosophy and process for the last 5 years, but certain things have evolved in terms of the sectors and opportunities that we are looking at now, which is quite different to the last 5 years. So maybe if I just give you a recap of what we have done in the last 5 years, then you would get a better idea in terms of how we are evolving from here. So I think the first thing to flag was the way that we look at our company is we take a 5-year view in terms of the sector or company, and we want them to take a bigger share of the world GDP 5 years from today. So when we started back in September 17, our view was that anything that relates to digital transformation would become a bigger part of our day-to-day 5 years later, which is basically in 2022. And what we meant by digital transformation would encompass e-commerce, shopping online, digital payments, digital advertising, software subscription, and cloud transition. And of course, we have the hybrid working from home, which scenario, which has mainly started since the pandemic. So basically, at the time that we were very much invested in this space, the likes of Google, PayPal, Amazon, PayPal, and then at the same time, Microsoft and some other names. It's not because that we are a tech fund, because as I already pointed out, that we run a global mandate. We want to find the best company, which is about 25 to 35 companies worldwide. And we built the portfolio from a bottom-up perspective. At the time, those opportunities would be able to deliver a lot of outperformance, because in a few years later, let's say in 2022, we realized that a lot of our day-to-day has been consumed by either Amazon, YouTube, or making payments online and advertising online, etc. So I think that has been a shift in terms of how we conduct our day-to-day business. However, certain things have changed and evolved. And the few pointers I've listed out on this slide is basically interest rate regime on the back of high level of inflation has become very different compared to the last 5 years. And then the second thing, which is probably more material, is in terms of the geopolitics uncertainty in deglobalisation, the risk of recession, the cost of living crisis, the strong dollar, and which will lead to new opportunities that wasn't available before, is about reshoring of certain activities, which I would touch on shortly. But if I just maybe give you a quick recap on the performance of the fund over that 5-year period until recently, then maybe it would give you another layers of understanding what has happened in the market or what has happened in the fund. So basically, what I have got on this slide is specifically referring to the UK domicile fund, LF, Blue Whale Growth Fund, that we launched in September 17. So that is how we managed to have more than 5 years of data. And the specific Irish domicile fund that we're talking about today was only launched about 2 years ago. So you should be able to refer to the fact sheet that is attached in this webinar. If not, then you will get a copy of that so that you will be able to see the equivalent performance in the ICAP, but it's a mirror strategy. So the performance should be pretty similar. So what I've got on this slide is basically to break down the performance of the fund since inception in September 17 until recently, until the 16th of February, which was 2 weeks ago. And I distinctively broke the performance down into 3 buckets. So the first bucket is the first 4 years of the fund until December 21. And then the second bucket, which is the middle one, is the first 6 months of performance this time last year. And then the performance since July last year until February 16 this year. As you can see on this chart here, that the performance of the fund has been have done pretty well in the first 4 years. And we did not do well in the first half of last year, which is about 6 months. And then the performance started to recover from July onwards. If I want to focus specifically on what happened in the first half of last year, was basically a lot of that underperformance was due to the rapid changes in interest rate expectations. As everyone would know, that when Powell got re-elected in late 2021, that he started to talk up about hiking interest rate to a very high level. And it surprised the market slightly in terms of the magnitude of the interest rate increase, rather than whether we're going to have a high level of interest rate. It's just the rate of change has been quite dramatic. But what has been quite interesting to note was since July last year, after the first 6 months, that the market actually started to recover. So the market, the global market, was up about 4% in the second half of last year. Similarly for the LF Blue Whale Growth Fund, was up about a few percent last year. And then this year it has recovered a bit more. So basically the recovery journey started a bit, basically after the first 6 months of last year. And I think what is relevant on this slide is basically talking about the interest rate risk. Of course, it's not done yet because the Fed would continue to raise the rates for a bit further, but it's about the risk of the interest rate going up a lot higher from here versus the expectations. And to us, that the one-off valuation reset on higher level interest rate is approaching the end. So what we are going to experience in the next couple of years is unlikely to be impacted by significantly higher level of interest rate compared to where we are now. It would be more to do with the risk of a recession in terms of how the world is evolving, and which is I'm going to take you through a few of that in the next slide. So what I've got here is basically how we think about for the next 5 years. So on a high level, that we are still embracing the same philosophy, the same investment process, but then the opportunity set has been a bit different. The things that haven't changed would be things that relate to the digital world, that we still think there's a subset of the market that give us those opportunities that could deliver significant outperformance. And the names would be like Microsoft, Nvidia, Intuit, Viva, and a few other names. However, there's many more other names that we used to invest into that we no longer have exposure to. So if you follow the fund, you would have noted that in December 2021, we sold out of Amazon, so about 13, 14 months ago. And then this time last year that we exited both PayPal and Facebook in late January, early February. And then we had been reducing our position to Alphabet, Google last year. And then we exited Google in July last year. So in today's portfolio, that we no longer have any FANGs exposure. So we have never owned Netflix nor Apple, but then for other names that we have had them in the fund for a good period of the first 4 years of the fund, which is basically the slide that you saw earlier, but we no longer have that. I'm happy to touch on why we decided to sell those stocks if you're interested. So maybe make a note on the Q&A. But what we are basically saying is there's a lot of drivers or tailwinds for some of this company in the last 5 years is no longer in place in the next 5 years. And there's going to be a lot more headwinds for some of this company compared to the last 5 years. So hence we no longer deem their valuation to be attractive. So that's the reason that we exited those. On the other hand, about 2/3 of the fund that we still deem as fairly attractive. So some of the names I will touch on in a minute, and that would be the likes of Nvidia or Microsoft. On the other hand, we also noted because of the shift in geopolitics, in how governments or countries are thinking about themselves a lot more compared to before. So we are talking about deglobalisation here. And then we also recognize that interest rate is going to stay higher for longer. So that is higher for longer is very different to expecting the interest rate to go up significantly from here. So I don't think the market would have expected that the interest rate would go up to 8 to 9% in the US from about 5 to 6 this year. We're saying like the terminal rate, whatever that is going to be higher compared to before. So if you think that inflation would stabilize at about 3-4% in the US, for example, in the next couple of years, then the interest rate level could be at about 4-5%, which we are mostly there. But of course, shorter term, maybe the Fed would do a bit more just to be sure that inflation would be under control. But then once inflation is under control, then the rates would be reduced to a level that is above the rate of inflation, which would be much higher compared to pre-pandemic. That would be sub 2% inflation. We think inflation is going to be higher and hence the rates would be higher. So one opportunity that we started to go into was a company called Charles Schwab, which is the largest investment platform in the US back in the summer of 2021. At the time that we recognized that the interest rate regime is going to be very different in the next 5 years. Of course, what we didn't know is the interest rate is going to go up to such a high level. We would probably have thought at the time that interest rate would have stopped at about 4% and inflation would not be as bad as peaking at over 10% at the time. So hence the fund did not do that well in the first half of last year. But we recognize that the interest rate regime is going to be very different. So one thing that we don't do as part of our investment process is we only invest into company that we feel like we can make sensible forecasts or we can do reasonable research and we can get comfort in terms of what goes behind the balance sheet. And one thing that we don't invest into is banks, even though that they would benefit from a high level of interest rate, but then it's almost impossible to to get conviction on what goes behind the balance sheet in terms of the risk-adjusted weighting of certain assets or loans that they've made, etc. But Charles Schwab have the similar dynamic as benefiting from a high level of interest rate, yet they don't have the complexity of the balance sheet. So it's a pure investment platform that they would be paying less to the consumer in terms of interest on their cash balances, and then they are able to reinvest those cash in the high yielding assets. So that is what they do. And the other two sectors that we equally identify as attractive in the next couple of years is the US railroads, that we recognize that we're going to see more reshoring opportunity, especially in North America region. So the two US railroad that we have got in the fund, which is Union Pacific and Canadian National Railway, that they are linking the West Coast to Canada and Mexico. And we would expect more reshoring of activities in that part of the region. And last but not least, if you have followed the fund, that we have talked about this quite a lot previously, that we recognize that the energy regime is going to be very different in the next couple of years as well, on the back of the geopolitical crisis in Ukraine, the war in Ukraine, and the geopolitics uncertainty in Asia Pac, and also the deterioration of relationship between Saudi Arabia and the US. So we think that the oil price would be able to be supported at a high level versus the previous cycle, despite a recession yet to come. So we have invested into a company called Canadian Natural Resources, that we have actually got an article written about that on our website if you're interested. But what is all important about what the changes we make on here is we are still sticking to the same investment philosophy, that we need this company to be high quality to start with, and then we need their valuation to be attractive at the same time. So this is what we have done. So I have prepped a few examples just to give you a bit of an idea what sort of opportunities that we are very keen on at the moment. So the first one is reshoring opportunities. I've just mentioned about the US railroads. But if you really go into where's the biggest opportunities in reshoring is in semiconductors, in terms of the new foundry that is going to be built. So the two stocks that we have got on our top 10 is ASML and Lam Research, and you can read more about that on our top 10 page, which is attached. But what I want to show you on here, which is a slide that I borrowed from ASML, that this is basically showing you the commitment of the new semiconductors foundry going to be built in the next 5+ years. We are literally talking about $300 billion had been committed to build new foundries in the US, in Europe, in Japan, and in South Korea. And that is never the case in the last 5 years or 10 years if we did not have the geopolitics uncertainty in Asia, basically the risk of Taiwan from China in terms of what's going on. And as we all know, that TSMC, which is the biggest manufacturers of semiconductors, majority of the asset is based in Taiwan. So if Taiwan is under attack, then the world could come to a halt, because everything in today's world would need some sort of semiconductors. And I think people would have experienced that during the pandemic. If you want to buy a new car or you want to get some things, like that's been a massive constraint in supply chain because they couldn't get the semiconductors. So this is a very big reshoring opportunities, that if you're selling high-end equipment into these plants, which is basically what ASML and Lam Research are doing, then in the next couple of years, you can literally see that the duplication of the production capacity in the Western world away from Taiwan. So they're going to sell many more equipment in the next couple of years. So this is one of those opportunities in reshoring on top of the US railroads. The second one that I have put in here is something different. This is not about the not so much about what happened in the last 5 years and what's going to happen in the next 5 years. But of course, if you follow the pandemic period when we were talking about the vaccines, that one reason that we managed to have a vaccine so quickly was because the vaccine was developed using biologics, which is a completely different method of coming up with a drug compared to before that is through a chemical process. And what this company does, Sartorius, is they sell the equipment into the drug production facilities. And of course, once you are into the production facility, it will be spec'd into kind of the drug approval that it would formulate kind of when you go through the FDA to get the drug approved, then how you produce the drug in itself in terms of the process, in terms of the equipment that you use would be part of that approval process. So what it means is once the drug get approved, then the longevity of the equipment that you're selling into this drug production would be very long life, in terms of that it would be almost impossible to have a competitor to come in to say, oh, I maybe sell you my equipment at a cheaper price, because then you need to go through the FDA process again. So what have changed is, in terms of next 5 years, is we believe that the acceleration or adoption of drugs being developed using biologics is going to get accelerated from here. At the moment, in today's world, it's only 30% of the drug is being produced using organic biologics. The other 70% is still are still using chemical processes. In the next 5 to 10 years, we would think this number is going to be at least about 50%, if not 2/3 of the market, just because it's working a lot better in terms of the success rate, etc. So we really like this company. It's on our top 10 as well. The last company that I have prepared to talk about today is Nvidia. So Nvidia remained my favorite holding in the fund, is equally on our top 10. And the thing about Nvidia is there are many things it does. Like I don't know how well you follow Nvidia. So historically, Nvidia as a company has been very well associated among like the crypto mining, about the gaming community. But in the next couple of years, that's going to be very different. So in today's world, we are talking about automation, robotics, artificial intelligence, which I will come back on that later. And then in terms of the personalization in recommendation system on a hyperscale data center, given that how much of our data are now online, that they could be analyzed and utilized and then basically then output some recommendation back to us. And a lot of these processing would be very suited to NVIDIA's GPU, which is very powerful. That's how NVIDIA GPU first got started in the crypto mining or the gaming space, because they are very task specific in comparison to the general purpose computing CPU, which is the chip that we mostly use in our computer. So what has been even more interesting this year, if you follow the development of ChatGPT, that this is going to be game-changing as far as the artificial intelligence development is concerned in the next couple of years. Because historically, before this year, when we talk about artificial intelligence, it's mostly used by engineers, by scientists, by the software developers, maybe working at Google, maybe working for a big healthcare company, trying to come up with some sort of DNA sequencing, etc. Like it has never been, it was never available to us as a consumer. But if you have used ChatGPT, if you haven't, I encourage you to do so. That is basically in a similar context as Google search, but a lot more powerful. And what we have seen as far as the ChatGPT is concerned is only a glimpse of what is possible in the artificial intelligence world in the next couple of years. So there's a lot of limitation in terms of what ChatGPT can do or not do. But then what we believe is that many other variation of ChatGPT that might be another one going to be very good with numbers crunching, analyzing financials. That would be another one that's very specifically designed to analyze drugs, or in the healthcare space. There's so many of those. So as far as ChatGPT is concerned, it's only a small part of what is going to be achieved. So if you ask us to bet on, oh, is ChatGPT going to be successful? Is Bing.com, which is Microsoft search engine, going to take share from Google because they're going to embrace ChatGPT technology? We don't know that. I mean, we hope that they're going to take some share from Google because we do own Microsoft in our fund. But what's been quite clear is whether ChatGPT is going to be successful or whether there's going to be other equivalent of the AI chatbot would be successful. They would still need to use Nvidia's GPU to process the queries real time, to use the GPU to train the AI to be able to perform certain tasks. So Nvidia is basically the backhand or the infrastructure to power artificial intelligence in the next many years to come. So that is why we are very excited about this company. And so then, of course, if you then look at the competitive positioning of the company, return on invested capital, balance sheet strength, etc., is all up in the top notch, and is still led by the founder that founded the company over 20 years ago. And so we really like this company, and this is something that we think that this is going to be a new journey for Nvidia in the next 5 years. And this is those niche, this is one of those highly selective opportunities that we think, irrespective of what the world is going to head into, which is very uncertain in the next 5 years, but this company will still benefit. The last slide that I have prepared on here is just to maybe remind people, if you haven't seen our top 10, these are our current top 10 position. The top 10 position account for about 50% of the fund. And what you see on the right-hand side, which is the two chart that I prepared, is slightly different to the numbers that you see on our fact sheet. So if I just run through that, maybe give you a bit more color in terms of what we have on here. So the first pie chart is at the bottom right. So what we have done here is basically look through the portfolio in terms of where our company makes their money in terms of revenue exposure. That if you look at our fact sheet, you will see that close to 70% of our investment is into US equity. So they're American companies listed in the US. But of course, some of these companies are global companies, and we haven't got a lot of exposure in Asia Pacific. We have one company called Nintendo that we invested, but then we do have exposure to Asia Pacific through luxury, through certain semiconductors company, etc. So this is just showing you how the portfolio is positioned based on its underlying exposure, that we had about 50% exposure to North America, just about. The other chart above is just to show you when we categorize certain opportunities such as MasterCard, Visa, and Intuit as financial services rather than technology, as per our fact sheet, that we have actually a smaller exposure to technology than has been kind of shown on our fact sheet. That is about probably less than 30% of the fund, and the other 20% would be in financial services, followed by healthcare, etc. So the fund in itself, in terms of the underlying exposure or sector exposure, is a lot more diversified than what it appears to be on the fact sheet, just because the definition of certain sectors are different. So if I just stop here, and happy to take any questions on companies or sectors and any points that I have talked about before or not talk about.
Thanks for that, Stephen. We do have a couple of contributors from the floor today, so we'll just launch straight in. One question, can you elaborate further on why you sold Alphabet in 2022? And also, are you comfortable with Microsoft as a holding going forwards?
Yes, thank you for the questions. So I will try to do this quickly. So basically, the reason that we exited Alphabet Google in the summer last year was mostly to do with our view on the high level of recession risk, which would impact advertiser spending, impact consumer spending in terms of discretionary or disposable income. And if you follow what Google does, about 90% of the business is through digital advertising, which is online searches. And during the pandemic, when most people were sitting at home, getting a paycheck from the government, there's a lot of money to be spent in getting stuff that we don't need, which I'm sure some of us might have experienced at the time because there's nowhere else to spend the money. We were locked down at home. And then during that period, the conversion rate in terms of how advertiser would bid for the advert would be very high because the conversion rate could be 1 in 3. So every 3 people who click on an advert, that one person will be converted. So you and I will be outbeating each other to get to the optimal level to get the most business at the time. However, because of inflation narrative that we have experienced last year and is going to continue for a bit longer, maybe we're not going to see 10% inflation, but we can easily see 5% inflation. And at the same time, the higher level of interest rate, which then feed into higher mortgage rate if you still have a mortgage to service. And then at the same time that the world is just not in such a fancy place in the next couple of years compared to before. So what it means is we have less money in our pocket to spend. So we are going to be highly selective in terms of how we spend our money. And if you're an advertiser, you were spending the same amount of money advertising your advert, now the conversion rate could be a lot lower. So while you are still clicking on the ad, but the conversion rate could be 1 in 10, that only one person is going to be converted to make the successful transaction, but then the other 9 is not going to. So then you and I as an advertiser will be underbidding each other. We'll be paying Google a lot less money going forward because we have less money to spend as consumer and the conversion rate is a lot lower. So that was purely on the back of that. But of course, what have changed recently that people have asked us, looking at the share price of Google now or valuation, surely is a lot cheaper. Maybe you should reconsider. We are definitely not reconsidering our investment into Google anytime soon. The reason for that is new news, which is the risk of the ChatGPT that could potentially disrupt the Google search model. So if you have used ChatGPT, which I talked about before, that you will know that a lot of things that it's actually giving you a better answer, or in terms of efficiency, in terms of how quickly you can go about that. And if you follow what Google does in terms of the business model, it's about user-generated content, it's about ranking of pages done by consumers or users. ChatGPT doesn't do that. And what the potential of BEng.com utilizing ChatGPT to take some share from Google, which at the moment is 90% Google search, less than 10% BEng.com, in 5 to 10 years' time, it could be 70-30. Or it could be 50-50. We don't know that. Like at the moment, it's unclear. The other thing about ChatGPT is that what it means that historically, if you want to build a search engine using the same algorithm as Google, which is basically relying on user-generated content, relying on our ranking to decide whether the pages is relevant or not, going forward, you don't need that anymore. You just need to train a AI algorithm and the AI will learn it by itself. So I would not be surprised in the next couple of years, we're going to see a similar kind of AI power search engine from Apple, from Amazon, from anything, any names that you think of could be interested in this space, and Google would be under threat. So basically there's a massive thesis violation that Google's market share in online digital advertising in the next 5 years could be severely challenged. So we are watching the space at the moment and we're not interested in revisiting the company. In contrast, Microsoft is a very good company that we want to talk about. that everyone is familiar with. The thing about Microsoft is, if you look at the share price of Microsoft last year, that it was down about 25%. I think at one point it was down about 30%. But what we have done is, I don't have the chart in today's presentation, but I mean, feel free to plot this if you have a Bloomberg or some other system. If you look at the share price performance for Microsoft since September 17 until December 2022, which is 2 months ago, that the share price has gone up 250%. 5 years, 250%. If then you ask me, oh, why is the shares gone up 250%? Then I would say to you that Microsoft is now making 250% more money now compared to 5 years ago. So basically, if you plot the earnings revision upgrades or the earnings, the next 12 months of earnings on Bloomberg since September 17 until December 2022, that is equally gone up 250%. So basically, that 250% performance has been backed up by 250% increase in earnings. However, that the share price was down about 25% last year, but that was purely from our observation. A lot of that was due to interest rate reset, which is one-off, that the interest rate gone up from 1% to 5%. And then the earnings downgrade from Microsoft, because of course there's always risk of recession, that is only 6 to 7% downgrade. So it is actually not that significant in terms of the money that Microsoft is going to make less in the next few years. And we expect Microsoft, based on our research, that Microsoft will still be able to grow its free cash flow by about 15% a year in the next 3 to 5 years. So how Microsoft is going to make back the 25% loss if you invested at the peak, probably 9 months ago or something, then it's all about the free cash flow delivery from here. Unless that you think interest rate is going to go up from 5 to 10% in the US in the next couple of years, then of course Microsoft shares would not be going up. It will be going down, and the equity market will be going down as well. I don't think that is a base case scenario. So if you assume that interest rate is going to stay roughly about 5 to 6% in the next few years, there's no further valuation reset, then it then would go back to the company fundamentals, which is a free cash flow delivery. And we think the competitive positioning of Microsoft over the medium term has become stronger rather than weaker compared to Google, Facebook, PayPal, Netflix, or anything like that. We would not consider that Microsoft competitive positioning has become a better company or much stronger positioning.
Great. So thanks for that. Very comprehensive, Stephen. One of your slides focused on Nvidia. One of the questions is, are there any alternatives to Nvidia's GPUs, and who are their key competitors?
So at the moment, the only equivalent of that is AMD have some AMD version of the GPU in the gaming space. So if you have Xbox or Sony PlayStation, that AMD GPU is in that. But that is more on a consumer, on the kind of consumer gadget perspective. In terms of the higher end, basically in the hyperscale data center, in terms of the very specific tasks, even crypto mining, historically when crypto was very hot, they will be using the Nvidia GPU because it's been proven that the product in itself is very good. Then, of course, at the same time, what separate Nvidia is they also have a programming language called CUDA, C-U-D-A, that if you were in the university learning about, if you're an engineer, that you're learning about programming a chip, then you wouldn't be learning this language. And this CUDA language is specific to Nvidia. So if you're going to program the CPU, which is only one standard, then you learn the language, but the CPU is a commoditized market. But if you want to program a GPU, at the moment, majority of people would have learned CUDA. So in terms of the programmers who know the language, the CUDA gives Nvidia's the competitive positioning another leg up compared to competitors. So of course, you can start up a new GPU maybe from scratch, but then of course, but at the same time, you need to get the community to get the traction. And once you get to a certain stage, that it's very difficult to catch up. And at the last point I will make on this is certain hyper scale data cloud providers like Google. They have their own GPU in some places, not everything, but then that's really specific to Google. So you wouldn't be expecting Google is going to sell the GPU that they use to power some activities on YouTube or Google search, etc. So as far as we know, that at the moment there's no clear competitors as far in Nvidia's context, but we do track the development quite closely. So that's very important. That's our job, to make sure that on a evolving basis, there's no new competitor coming in. So in today's context, we can't see a competitors coming in the next 5 years to challenge competitive positioning of Nvidia, but we continue to track that in the following 5 years.
Great stuff. Always an interesting question. What views do you have on Tesla?
So we have never owned Tesla before, and if you follow us, that I have actually spoken about why Tesla was in a bubble at the time a few years back. But of course, what had been slightly annoying was the Tesla share price managed to peak at about over $1 trillion in a very during the pandemic period, and now it's gone back to about 500 to 600 billion. So what doesn't work for us is we look at the fundamentals of a company. So if we look at Tesla, we look at Nvidia, we look at Microsoft, we use the same lens. We look at the competitive positioning, we look at the return on invested capital profile, we look at the number of competitors that is in the space, we look at how sticky the customer base is. And as far as Nvidia is concerned, they did have the first mover advantage into the EV car, which is about probably more than 5 years ago now. But then in today's context, if you follow Mercedes, Volkswagen, Toyota, and many more Chinese automakers, that we know that many options of an EV vehicles. So then the question is, if you think and Tesla, which we think Tesla is an auto company rather than a technology company, then we will be scoring Tesla relative to other company, and we don't think the competitive advantage is that big. I mean, of course, they do have a bit of branding in terms of the first mover. They do have a better software, but then still, it's not everyone is going to pay 50K for a new car, isn't it? Some people are not going to afford it. I'm happy to pay 30 for a lower tier version, etc. And that's how the world works. And if you want to justify the valuation of Tesla based on the number of cars they're going to sell for about $500 to $600 billion, then they need to sell about 25 million cars in the next 5 to 10 years. And the world only sells about 50 million. So basically, that's 50% market share of the new world, which is in 5 to 10 years' time, that 50% of the car that you see on the road will be Tesla. We don't think that's possible. It could be possible, but it's very difficult journey, because you would have to expect some other companies going to disappear, like GM, like all these companies, which they're a very good company. So the only way to justify the valuation of Tesla is you have to believe in Elon Musk. If you believe him, which let's say 5 to 10 years ago, you would have made a lot of money. But from our perspective, we can't actually quantify the value of Elon Musk. I mean, he's just a person. I'm sure he's a genius. He's a very successful entrepreneur. But you need to put the substance. So as far as the substance is concerned, we cannot justify the valuation in Tesla's context. But let's say in Nvidia or Microsoft, of course, it's run by very good management team, or let's say in Nvidia context, it's still run by the founder. But we are not going to put a value on the founder. We're going to put a value into the financial of Nvidia. We're going to put a value in terms of how many products they're going to sell, in terms of competitive positioning. So that is our take on Tesla. Is if you believe in Elon Musk, which we can't really quantify it, then maybe you can justify valuation. If you don't believe in Elon Musk, there's no way that Tesla should be worth at $500 to $600 billion.
Great stuff. And another one here from Stephen regarding the growth style. When do you think it will regain its tailwind, or have investment conditions changed that it's gone as far as it can for the foreseeable future?
Yeah, so there are two things just to note. So one thing is I have flagged a few growth traps. I didn't have time to talk about this. Many names that were very successful during the pandemic, like Uber, Lyft, WeWork, like there's so many others. There's no time to go through that now. A lot of these stories or company are now broken, like structurally broken. Like they would, like some of these shares or even Zoom, they would be down like 70 to 80%. They would never recover to the peak. Like Netflix, in the next 5 to 10 years, they are only going to control about 20 to 30% of the market, which compared to the previous expectation, if we want to stream video content, they would have at least 2/3 of the market. Nowadays, we know that they are not the single company who is going to offer us content at home. There's many alternatives, and there's only so much money we can spend. So in terms of whether Netflix is going back to $300 billion at the peak, we think is fairly unlikely. So certain companies are structurally broken. You need to be very careful. But of course, for the likes of Nvidia or some other names that we still own, we believe that the fundamental is going to carry them through. So this is one thing. The second point I want to make is about you need to take a view on the interest rate. Our view on interest rate is going to stay higher for longer. So in the next let's say in the next 3 years at least, we would think the interest rate would be a lot higher than the 2% regime that we have experienced before the pandemic. And if that's the case, then even like whether your growth, like if you're a very high growth company with no earnings, like you're unprofitable, then it will be impossible for them to recover. But if you think in the next 3 years, the interest rate is going to go back down to 1 to 2%, then any crappy company, any company that doesn't make money that I'm saying like they are structurally broken will recover, because that's just how valuation work, which is like a one-off reset, isn't it? That's what happened before. But then because certain companies have structural issues, hence they're not going to recover unless interest rate get back down to a very low level. We don't think that's going to happen anytime soon. And of course, by the time it happened, let's say maybe if we get to 2% interest rate level again in 5 years' time, some of this company might have run out of money. So they might not be around anymore. And so you need to be careful in terms of the timing. You can't say, I'm going to invest in this company now. I think interest rate might be lower in the next many years. It could be too long and they have run out of money and they just disappear in the meantime. Like I think we talked about Peloton before, the home bike company that's selling you like £2,000 bike at home. I'm not sure who is going to buy it anymore. Like you go to gym, it's a big commitment to spend £2,000 on a bike. So they could easily disappear. But if interest rate go down to 1% tomorrow, I'm sure they go up a few 100%.
Great. So, and last but not least, because I know we're sort of edging towards the edge of our timeline here. We've been asked, in terms of your trading style, do you have a limit on the amount of stocks held at any one time in the portfolio? And how often do you look to rotate holdings?
Yeah, so in terms of the approach, is I the manager mentioned is we run a highly concentrated portfolio between 25 to 35 stocks. So on average, we have never gone about 30 stocks. So at the moment, it's about 26, 27 stocks in the fund. So typically, we keep it below 30 names. And if we have a new names after we reach 30, then it's one in and one out. And we always want to refresh the portfolio in a way that it gives you the most outperformance potential for the next coming years. And of course, those opportunities will evolve in terms of valuation. Certain things that we like might not was attractive when we first started the position could become more expensive, and then we find a better idea, then we put it into the fund. And in terms of the turnover of the fund, that every year you could expect about a quarter of the fund will be different. So out of the 25 names will be a couple of names, new names will be coming in, which we talk about today, and then a couple of names would go out. So we try to refresh the portfolio. So every year you could expect a quarter of the fund to be different, a couple of names.
Great stuff. Well, thanks for fielding those questions, Stephen, and thanks for your session this morning. Very enlightening. As Stephen mentioned in his session, there are a couple of attachments which are available to download. They are the fact sheet as well as the top holdings. And as always, we will make a recording of today's session available within the next 48 hours. Keep an eye out in your inbox. We will be having our Pulse newsletter being issued tomorrow. And our next advisor webinar will be on the 15th of March, when we'll be joined by Marlborough Investments. So it just leaves me to thank you once again, Stephen, for your time and contribution this morning. Thank you to everybody who attended today, and hopefully we'll see you again very shortly. Thank you.
Thank you.